The benchmark stock indexes looked at dismal performance yesterday. The blue-chip Dow Jones index lost all its gains of 2023 and entered negative territory. Wall Street indexes opened today sharply lower, but they found support from a fresh employment data. At the same time, market sentiment remains gloomy amid fears, mounting risks and uncertainty. For a start, let's sum up the results of the previous trading day. The major stock indexes closed with losses. The Dow Jones tumbled by 1.29%, the Nasdaq sank by 1.87%, and the S&P shed 1.37% to close at 4,229.5 points. The key indexes spanned the New York pre-market with the same mood. The S&P briefly dipped below 4,200 points, and later on the stock indexes perked up before the opening bell. Futures on the stock indexes gained 0.04 and 0.3%. The S&P has to settle above 4,332 points to develop a steady rally, and the index could turn down after it declines below 4,203. The S&P closed on Tuesday at the lowest level since June 1 as the economic data cemented the viewpoint that the Federal Reserve would pursue its hawkish monetary policy for longer than expected. Atlanta Federal Reserve Bank President Raphael Bostic said that the central bank does not have to raise interest rates higher. Still, a long time is needed to realize that rate cuts would be appropriate, and his caution was dispelled by Cleveland Fed President Loretta Mester, saying that she would vote for another rate hike at the nearest policy meeting. Investors continue to closely monitor benchmark 10-year Treasury yields, which hit a 16-year high on Tuesday. As a result, mega-cap tech companies incurred sharp losses. Tesla lost 2%, Nvidia 2.8%, Meta 1.9%, Amazon shares also plunged by 3.7%, and Microsoft fell by 2.6% after it became known that the British regulator would push for an antitrust investigation into the company's dominance in the British cloud computing market. Futures for Wall Street's major indexes traded sluggishly on a Wednesday as investors waited for more macroeconomic data. Besides a relentless rise in long-dated U.S. Treasury yields kept markets on edge, while the 30-year Treasury yield climbed above 5% for the first time since August 2007. The 10-year and 5-year yields reached the highest levels also since 2007. The mind-boggling rise in long-term U.S. government borrowing costs continues to hammer global markets everywhere as investors fear that 30-year bond yields above 5% will inevitably lead to financial distress somewhere in the system. Apart from this risk, investors are also worried about a looming government shutdown next month. The reason is the forced resignation or unprecedented ouster of Speaker Kevin McCarthy on a late Tuesday night by his own party. Amid a split in the U.S. Congress, hawkish Fed policymakers, and rising Treasury yields, macro statistics helped the stock indexes pull back from the brink before the bell. The JOLTS job openings report showed an unexpected rise in vacancies in August, and next day the ADP employment report revived a faint hope among investors. The U.S. private sector added just 89,000 jobs in September, the lowest growth since January 2021. The figure is way below the consensus of 153,000 new jobs and also down from 180,000 jobs in August. Despite some signs of a cooling down employment, the market could give a muted response as investors are anticipating the government employment data on a Friday. In the currency market, major currencies are going through corrections against the US dollar. The greenback lost its footing, its index dipped by 0.3% by the opening bell and opened the New York session at 106.60 points. The US dollar has appreciated by almost 3.5% in the last 3 months on the back of a sharp rise in the US Treasury yields. Being strongly overbought, the US currency needs a downward correction. The Canadian dollar is extending its weakness. The USD CAD pair grew by 0.28% in the pre-market to trade at 1.3740. The currency pair is trading firmly higher amid expectations that the US Central Bank would push ahead with its monetary tightening. The instrument is likely to approach 1.3860 in the short term. Oil prices stalled the Lunis recovery against its American rival. Oil prices collapsed intraday because of the fears about soft energy supply due to macroeconomic woes and the overvalued US dollar. An online OPEC Plus meeting on Wednesday left the cartel's production policy unchanged. Saudi Arabia's energy ministry confirmed on Wednesday that it would extend its voluntary cut in crude oil supplies by 1 million barrels per day until the end of this year. Russia has said it would continue its current cut in the oil exports by 300,000 barrels per day until the year end. In November alone, it will reconsider its voluntary production cut by 500,000 barrels per day set in April. The crypto market is trading mixed today, though traders have reasons for optimism. Bitcoin has got stuck in yesterday's trading range, and the token was 0.2% up before the opening bell. It opened the New York session at $27,400. As for the intraday outlook, Bitcoin might trade today inside the range of 27,400 to 27,650. If the price breaks the lower border, it might fall to 27,000. Alternatively, the token could climb to 27,750. The catalyst for the bullish sentiment today was the Ripple coin. First, the court rejected the interlocutory appeal of the U.S. Securities and Exchange Commission. It means that the Commission did not find compelling reasons to challenge for court's decision that Ripple is not a security. In addition, Ripple's Singapore subsidiary has received a payments license to operate in the city-state without transaction limitations. Among other things, the U.S. House of Representatives appointed Patrick McHenry as the temporary speaker, who questioned Gary Gensler at a recent congressional hearing and who is quite positive about the cryptocurrency market. We hope that our market review will help you make well-rounded trading decisions. We are open for all your questions and offers, so see you online tomorrow.